Imagine a world where the strongest economy on the planet isn't as strong as it looks, where soaring stock markets and record GDP numbers are nothing more than a sugar rush illusion, and the smartest investors are quietly running for cover, pouring their wealth into gold as if preparing for the storm that's coming. Tonight, we uncover the hidden cracks behind the headlines, the signals no one wants to talk about, the market warnings screaming louder than ever, and why the comedown might hit harder than anyone expects. This isn't theory. This is happening right now. And if you're not paying attention, you could be blindsided. Investors and market observers increasingly describe the current strength of the U.S. economy not as a foundation of organic, sustainable growth, but as something closer to a temporary sugar high, a boost driven more by policy impulses than by underlying economic health. What this means in practical terms is that the appearance of strength, high GDP figures, rising asset prices, and resilient consumer activity can sometimes mask structural weaknesses that may soon reassert themselves once the artificial supports recede. This notion has gained traction because of several observable market behaviors and economic signals that, when connected, paint a complex picture of growth that might not last. First, let's look at the performance numbers that seem impressive on the surface. Recent government data reported that the U.S. economy grew at an annualized rate of about 4.3% in the third quarter of 2025, marking the fastest pace in 2 years and beating many economists' expectations. This expansion was driven by robust consumer spending, which accounts for roughly 70% of economic activity, as well as increased exports and investment in technology, particularly artificial intelligence and related equipment. On paper, this looks like a strong economy firing on all cylinders. Yet beneath these headline numbers, some underlying trends suggest that this strength may not be self-sustaining. Consumer confidence, for example, has continued to decline for several months, pointing to a divergence between the statistical measure of GDP growth and the sentiment of everyday individuals about the future of their finances. This kind of disparity is what macro observers refer to when they talk about superficial strength. Numbers look good in aggregate, but broad segments of the population are feeling economic strain. The Guardian. What amplifies concerns is the behavior investors are displaying in global capital markets. Instead of allocating capital more aggressively into risk assets like stocks and corporate bonds, which would typically be expected in a truly confident growth environment, many market participants have been shifting funds into traditional safe haven assets such as gold. Gold has been on a historic run, reaching all-time highs above $4,500 per ounce at certain points in late 2025. This kind of gold price move typically reflects a broad desire to preserve value in the face of uncertainty about inflation, currency stability, or future economic conditions. The rally in gold prices, co-occurring with positive GDP figures and high equity valuations, is paradoxical. In typical economic cycles, gold rises when growth slows or risk assets fall. But the current environment has seen gold rally even as headline economic data remains strong, hinting that investors may be hedging against future downside risk rather than participating in a straightforward growth story. That divergence, strong data versus risk-averse positioning, is a classic hallmark of a sugar-high economy. It suggests that investors are not fully convinced that today's growth is built on solid fundamentals. Another piece of evidence comes from expectations about monetary policy. Despite the recent economic resilience, markets have been pricing in the likelihood of future interest rate cuts by the Federal Reserve. When market actors anticipate easier monetary policy responses ahead, it often reflects concerns that economic momentum might be slowing beneath the surface, triggering reduced borrowing costs to stave off a downturn. Rising bets on rate cuts can weaken confidence in the stability of the current expansion and keep investors cautious. All of this intersects with the concept of fiscal and monetary support acting like a temporary stimulant. Large government expenditures, prolonged loose monetary policy, and stimulus measures can elevate economic activity in the short term, much like sugar gives the body a burst of energy. But once the effects of that stimulus fade, or if headwinds like inflation, policy uncertainty, or geopolitical risk intensify, The economy may slow abruptly. Genuine growth, in contrast, tends to be supported by productivity gains, sustainable employment growth, and durable consumer confidence, factors that are currently mixed at best. When these elements are put together, extraordinary gold demand, economic figures that tell one story. While confidence indicators tell another, and investors seeking hedges rather than opportunities, the case strengthens that the economy's current vigor may be more a sugar high than lasting strength. Whether this calm down happens gradually or abruptly, and how markets react when it does, will be a defining theme of the coming economic cycle. In recent months, one of the clearest signals of shifting investor sentiment in global markets has been the increasingly strong movement of capital into gold and other traditionally safe haven assets. This isn't a minor adjustment. It's a fundamental change in how both institutional and retail investors are positioning themselves, and it's rooted in deep-seated concerns about economic uncertainty, policy risk, and the long-term stability of conventional financial assets. What we are observing is not simply speculation on a rising price, but a flight to safety, a reallocation of wealth from riskier, growth-oriented investments into assets that preserve value when confidence erodes. Gold's rally to historic highs, recently surpassing $4,500 per ounce and marking gains of more than 70% year to date, is a powerful expression of this shift. Investors are not behaving this way because everything in the global economy is unambiguously strong. Rather, they are acting out of caution in the face of persistent geopolitical tensions, evolving policies, and macroeconomic headwinds that have reshaped risk perceptions. These aren't short-term market jitters. They reflect a broader reassessment of where stability lies amid uncertainties that appear structural rather than transient. A core driver of why gold has become so attractive is its role as a store of value when confidence in traditional financial assets wanes. Unlike stocks or corporate bonds, which depend on earnings growth and investor risk tolerance, gold does not yield dividends or interest, and that's precisely why it shines in uncertain times. When investors are genuinely confident in the economy's future trajectory, capital flows toward assets that can generate returns. But when confidence weakens even slightly and the focus shifts to preserving capital rather than maximizing gains, gold becomes the refuge of choice. The macroeconomic backdrop has encouraged this dynamic. Across major economies, inflation has remained stubbornly above central bank targets, even as policymakers signal willingness to ease monetary conditions. Lower real interest rates diminish the opportunity cost of holding a non-yielding asset like gold, making it relatively more attractive. In addition, expectations of future rate cuts, particularly in the United States, have softened the US dollar, amplifying gold's price gains. Since it is priced in dollars, it becomes more accessible to international buyers when the currency weakens. This combination of weak dollar dynamics and dovish monetary expectations has fortified gold's safe haven appeal. Beyond monetary policy, geopolitical risk has played a significant role in driving investors toward gold. Ongoing conflicts, tensions in energy exporting regions, and trade disputes have all contributed to a heightened risk premium embedded in global markets. When political uncertainty increases, risk sections of portfolios contract, and assets perceived as stable, like gold and certain government bonds, expand. This is classic flight to quality behavior where capital is reallocated not for growth but for preservation. It's also important to note that central banks themselves have been active participants in this trend. Many central banks around the world have been steadily increasing their gold holdings, not only as a hedge against inflation, but also as part of broader diversification away from heavy reliance on dollar-based reserve assets. These institutional purchases provide a structural underpinning to price support and reinforce the narrative that gold is being accumulated for strategic reasons, not just speculative ones. At the same time, the broader pattern of investor behavior suggests a cautious rebalancing. Funds that track gold and gold-backed ETFs have seen significant inflows, while allocations to more volatile asset classes have become more conservative. These flows aren't the result of isolated trades. They reflect a collective recalibration of risk preferences across global markets. What does this mean in practical terms? It means that investors are acting on a belief that the path ahead may be more uncertain and less linear than conventional economic models suggest. They are prioritizing assets that retain purchasing power when currency values fluctuate, when equity markets correct, and when policy responses remain unpredictable. Gold's ascent is not merely a function of price momentum. It is rooted in a foundational shift toward capital preservation in a world where uncertainty increasingly shapes investment decisions. In essence, the retreat to gold is a barometer of investor psychology, not just in response to headlines, but to the accumulation of risks that traditional assets may not fully price in. This sustained demand for gold, grounded in real economic and geopolitical forces, suggests a market that is preparing for volatility rather than celebrating triumph. Markets, over the course of 2025, gold has not merely risen, it has surged to historic record levels, underlining one of the most significant shifts in global financial markets in decades. Spot gold prices have repeatedly eclipsed previous all-time highs, with bullion climbing well above $4,500 per ounce in late December as investors increasingly seek stability amid a complex mix of economic uncertainty, monetary policy expectations, geopolitical tensions, and strategic reserve diversification by central banks around the world. At its core, this rally reflects a powerful reevaluation of gold's role in the global financial system. Traditionally, gold has served as a safe haven asset, a store of value that investors turn to when confidence in fiat currencies, equity markets, or economic policy weakens. In 2025, that historical role has reasserted itself with unusual strength. A combination of expectations around interest rate cuts by the U.S. Federal Reserve, concerns about currency debasement, and weakening bond yields has made gold especially attractive. When interest rates are anticipated to fall, the opportunity cost of holding a non-yielding asset like gold declines, prompting investors to shift capital from yield-bearing instruments into precious metals. Beyond monetary policy, geopolitical risk and economic unpredictability have significantly influenced the rally. Escalating trade tensions, ongoing conflicts in key regions, and fears of new sanctions and tariff wars have kept risk premiums elevated. These conditions tend to make traditional assets, especially stocks and corporate bonds, appear vulnerable, increasing the appeal of gold as a hedge against inflation and systemic risk. As news of record gold prices frequently dominates financial headlines, that very narrative reinforces investor psychology that this metal is not just a hedge, but a necessary haven. Another important driver has been the strategic behavior of central banks. Rather than merely reacting to market volatility, many national monetary authorities have been actively increasing their gold reserves, partly as a diversification away from heavy reliance on U.S. dollar-based assets. This institutional demand, particularly from countries in Asia and Eastern Europe, has provided a structural underpinning to price support, making the rally less dependent on speculative flows and more reflective of long-term reserve strategy. Investor behavior across markets also mirrors this shift. Gold-backed exchange-traded funds, ETFs, and other institutional investment vehicles have seen significant inflows throughout the year, indicating that both large institutions and retail investors are repositioning portfolios toward assets that preserve purchasing power. This trend is supported by broader diversification strategies, where gold is increasingly seen not just as a hedge, but as a central component of long-term wealth preservation. With gold prices repeatedly setting records, this reinforces confidence among investors that traditional assets may not be sufficient to hedge against macroeconomic volatility. The broader market context, where gold rises even while some equity indices hit new highs, is particularly noteworthy. That paradox underscores the delicate balance between market optimism and anxiety. While headline economic data may show growth in certain areas, underlying concerns about inflation persistence, debt burdens, and currency weakness have prompted investors to pivot toward tangible assets. Gold's performance in this environment reflects not just a technical rally, but a deeper shift in market psychology, one where capital preservation increasingly outweighs purely growth-oriented strategies. Importantly, this gold surge is not a fleeting phenomenon. Analysts and market forecasts have suggested that gold could continue to see elevated prices into 2026 as central banks maintain accumulations inflation dynamics remain uncertain, and investors reassess risk exposure in an era where traditional assumptions about monetary policy and economic stability are being challenged. The repeated breaking of price records throughout 2025 and the diverse forces driving these highs highlights how deeply asset allocation strategies are changing. In essence, gold's record-breaking ascent in 2025 reflects a global reordering of financial priorities. It encapsulates the growing sentiment that in a world of fiscal uncertainty, rising debt levels, shifting geopolitics, and evolving monetary policy, real value preservation increasingly matters more than speculative growth. The rise of gold is less about bullish optimism for traditional markets and more about cautious realism, a strategic move by investors to secure wealth in a time of elevated uncertainty and profound economic transition. What's happening right now in global financial markets isn't just a fluctuation in prices or a short-term rotation of capital. It reflects a broader shift in confidence about the US dollar's role as the unquestioned centerpiece of the world's financial system, and this is showing up in very real, measurable ways. For decades, the US dollar has been the dominant reserve currency. Countries held it because it was stable, liquid, and widely accepted for trade and finance. But now that long-standing equilibrium is being tested. Reserve managers and asset allocators across the world are increasingly questioning whether the dollar should continue to play that central role, especially when other assets and currencies appear better positioned to preserve value under uncertainty. One of the clearest pieces of evidence for this evolving mindset comes from a recent survey of central banks across 75 countries. It showed that a net 33% of reserve managers intend to increase their gold holdings over the next 1 to 2 years, the highest reading in at least 5 years. This is happening alongside a marked weakening in the preference for the dollar as a reserve asset, in part because political and economic considerations are making decision makers less confident in dollar-denominated assets. More than 70% of central banks surveyed cited the political environment in the United States as a reason for reducing their reliance on the greenback. Parallel to this survey, central banks themselves have been remarkably active in accumulating gold. For example, Poland's central bank has been increasing its gold holdings aggressively, while other emerging markets have also added significant amounts to their reserves. China's steady acquisitions over the past year have brought its gold holdings past 2,300 tons, and countries like Turkey, India, and several Gulf states have also been part of this broader buildup. These moves aren't random. They represent deliberate diversification away from dollar-centric assets and toward a mix that includes tangible, non-sovereign financial instruments. This trend is not just about gold prices going up. It's about a recalibration of what constitutes real value in uncertain times. When reserve managers ponder whether to hold dollars, euros, yuan, gold, or other assets, they are weighing not just expected returns, but the risk of loss of purchasing power, political leverage, and systemic exposure. Dollar dominance once came with the implicit assurance that issuing large amounts of U.S. debt was safe because global demand for dollar assets never wavered. But persistent fiscal deficits, rising national debt, and unpredictable trade and geopolitical policies have injected doubt into that equation, prompting reserve managers to rethink how much exposure they want to the dollar's fortunes. Another dimension of this shift is seen in how international trade is settling. More countries are choosing to conduct bilateral trade in their own or alternative currencies rather than the dollar. For example, a significant portion of China's settlements is now being conducted in the renminbi. BI and partnerships between countries like Brazil and Argentina with China showcase this trend. These arrangements reduce dependence on the dollar not through abrupt abandonment, but through incremental structural realignments in trade and finance. Such changes signal that markets are slowly but deliberately reducing their reliance on the dollar's centrality. The dollar's share of global foreign exchange reserves has also been slowly declining, even if it remains at a majority level. While it still holds a significant portion of international reserves, its share has shrunk from historical highs, and other currencies like the euro and yuan now occupy larger portions than before. This shift in composition is subtle but real, and it reflects a world where reserve diversification is increasingly seen not as optional, but as prudent risk management. Perhaps the most important point is that this change isn't happening overnight. There is no wholesale dumping of the dollar. Rather, there is a gradual rebalancing of portfolios and reserve compositions that reflects growing strategic caution. Investors and governments alike aren't exiling the dollar instantly. They are hedging against the possibility that its dominance could weaken further. They are asking what protects wealth best if global volatility increases. What instruments minimize counterparty and political risk? In answering those questions, many are choosing gold and other diversified assets over a sole dependence on the dollar. In this evolving landscape, the dollar remains significant, but its position as the unchallenged global reserve currency is increasingly being shared with alternatives that offer a buffer against risk, especially tangible assets like gold that have stood the test of time. This shift matters because it signals how confidence, the foundation of financial markets, is being recalibrated in real time. Right now, gold's price behavior is sending a very real market signal, one that goes far beyond simple price movements and enters the realm of economic psychology and early warning indicators. Gold isn't producing goods or services, it doesn't generate earnings, and it doesn't depend on dividends or growth forecasts. What it does reflect is investors' collective judgment about the future of uncertainty, risk, and stability in a world where traditional economic indicators may be misleading. In late 2025, gold has repeatedly climbed to new records, trading above $4,500 per ounce. And this upward trajectory isn't happening in isolation. It's happening alongside caution, volatility, and warnings from financial analysts and policymakers that the current market environment may contain latent stresses that haven't yet surfaced in headline numbers. When gold rallies to historic highs, particularly in a period where stock markets are also near elevated levels, it suggests something deeper than short-term speculation. A traditional narrative implies that strong economic growth and robust corporate performance would pull capital toward equities, credit markets, and growth-oriented assets. But when gold, a quintessential safe haven asset, is being favored instead, it's often because investors are hedging against future volatility that they believe is not yet fully priced into mainstream markets. Analysts have explicitly noted that such rising gold prices should be interpreted as warning signals rather than celebratory ones, indicating broader systemic uncertainty that could precede a shift in economic cycles. Part of this reaction stems from concerns about policy uncertainty and macroeconomic stress that are not immediately obvious in headline statistics. For example, rising trade tensions, geopolitical instability, and the expectation of changes in interest are 8 policies all contribute to a risk environment where preserving capital becomes a priority. When investors see upward pressure on gold, they aren't simply betting on price momentum. They are acting on anticipation of future risks that could disproportionately affect growth-dependent assets like stocks and bonds. Gold behaving as a leading indicator in this way is not new, but the scale of the 2025 rally, the largest annual gain in decades, underscores its significance as a barometer of sentiment that leans toward caution rather than confidence. This interpretation aligns with how central banks and institutional investors have been positioning themselves. Many of these major players are increasing their holdings of gold reserves precisely because they view it as a protection against currency instability, rising debt burdens, and the possibility of slowing growth. These aren't speculative bets, they are strategic moves informed by long-term assessments of risk, currency shifts, and reserve diversification. That such institutions are favoring gold reflects their own internal stress tests, which may be forecasting conditions that traditional economic growth figures haven't yet revealed. Gold's price action also interacts with broader market structures that historically serve as early indicators of economic shifts. For instance, measures like the inversion of parts of the U.S. yield curve, high valuation ratios in equity markets, and slowing momentum in commodities outside precious metals can collectively suggest that the economic cycle is maturing or entering a phase of greater fragility. Gold reacting strongly against this backdrop makes sense. Investors often move into precious metals when they suspect that risk premia are underpriced in mainstream assets, and when traditional models of growth may be too optimistic for future conditions. Importantly, gold's record highs are not just the result of narrative or perception alone. Tangible geopolitical events, policy deliberations, and shifts in monetary expectations are contributing to the upward pressure. When markets price in expectations of potential interest rate cuts or weaker yields, gold becomes comparatively more attractive because the opportunity cost of holding it falls. Similarly, when currency dynamics favor weaker traditional reserve currencies, gold acts as a natural hedge, preserving purchasing power in a way that liquid financial instruments sometimes cannot. These factors are observable in how gold's price has behaved relative to those macroeconomic indicators over the past year. Taken together, gold's ascent to record territory is more than a simple price trend. It is an early warning mechanism, echoing historical patterns where precious metals demand rises ahead of significant economic transitions. It reflects investors reallocating capital not because they are celebrating the present, but because they are making tactical decisions based on anticipated uncertainties in the future. That makes gold's rally a powerful indicator that markets are preparing for a potential shift, one where traditional confidence may be tested and where risk management becomes as important as growth orientation. So as the markets surge, the headlines celebrate, and confidence seems unshakable. Remember this: gold is climbing, investors are hedging, and the sugar-high economy is showing cracks beneath its shiny surface. The storm is not coming tomorrow, it's unfolding right now. The choices you make today, the attention you pay to these warning signs, could be the difference between being caught off guard or staying ahead. Stay alert, stay informed, and never underestimate the power of what the numbers and the markets are quietly telling us. The comedown is real, and the time to prepare is before it hits.